That's what the Bitcoin ETF yield generating strategy is. It's about buying ETF shares and then selling covered calls back to the speculators in order to generate yield on those shares. And a lot of the big market makers love this type of setup because I'm not going to say you can get delta neutral, but you can hedge downside as well. And it does squeeze a little bit of that yield down. But when you're a bigger market maker, when you're talking about these types of yields, that's a significant yield. And
Yeah.
the premiums that people pay in Bitcoin, because the implied volatility is higher, right? So you look at some of these strategies on other stocks like Apple or Tesla, they don't perform as well because the stock is limited in how much the market perceives that the price can move up. So people aren't willing to pay that high of a premium for the call option. Well, that's not the way it is in Bitcoin. Ingrained into Bitcoin is this story of volatility, which is displayed and made true. But what that does is when price right now is at $50,000, it allows somebody to say, hey, I think by next February, price is going to be at $100,000. There's no stock that exists that people think is going to be up 100% and they're willing to
Yeah.
pay a call option for it. So the implied volatility of Bitcoin really helps drive those premiums up. So these Bitcoin ETF yield generation strategies are attracting the attention of the biggest market makers in the game because the speculators are willing to pay the biggest premiums in the game because the implied volatility is the largest that there is in the game. So the stars are aligning for this strategy to outperform any other covered call strategy in the marketplace and to do it consistently because of that consistent volatility of Bitcoin being number go up technology.